Entrepreneur MBA podcast purpose is to help existing business owners grow their companies past the 10 million in revenue per year benchmark. Here is your host, Stephen Halasnik.
Hello, everyone. My name is Stephen Halasnik, and I am co-founder of Financing Solutions. For those of you who don't know Financing Solutions, we are a company that provides very easy to set up lines of credit for small businesses. And I will be your host, as I usually am, for today's Entrepreneur MBA podcast. If you're interested in learning more about getting a line of credit for your business, and again, we're a direct lender. We're not a broker. We are using our own money. And I'm passionate about the idea that every business should have a line of credit. Please go to our website, go to fscreditline.com. Again, FS is a Financing Solutions, creditline.com, fscreditline.com. If you would like to get a quote, if you'd like to see if you're qualified, for how much it costs, all those other things. I think every entrepreneur should have a line of credit in place. I know for almost the majority of my career, I always had a backup plan. That's what a line of credit is for. Over the last 25 years, I've built 6 companies in the $5 million to $25 million range, including 2 companies that have made the Inc. 500 fastest growing companies in the United States. I love learning from people with business experience. And today I'm very excited to be speaking with Reza Farahani. And Reza Farahani is a serial entrepreneur and data science consultant who most recently co-founded and exited WFHomie, a people analytics tool helping companies embrace data to make decisions that enable them to improve the employee experience and create productive environments, whether they're remote, hybrid, or on-site. Reza's experience has positioned him well to speak on all aspects of the startup environment, from ideation to exit, and as a visionary in the future of work sector. Reza, welcome to today's Entrepreneur MBA podcast.
Thank you, Stephen, for having me. Super excited to have this conversation.
Yeah, the cool thing is when I started this podcast, I think it was almost 6 years ago. I get to pick topics, and I get to learn about things that I'm really, really interested in. Today's session is going to be that way. We're going to cover what happened when you see your company can't scale. And I have some personal experience of this, as well. So, I'll be talking about that as well. But this is going to be a topic that I think, it's going to be fun for me to talk about it. Not talk about, but ask questions and listen to Reza as well. So, let's just start off with this. Reza, tell us a little bit about your background first before you started WFHomie.
Yeah, for sure. So my background, I'm engineer by trade. I did my undergrad and grad both in engineering. And then after I graduated, I started working as a data scientist in an innovation lab. Uh, we were responsible for creating new line of business or a new product for a big $1 billion company to diversify their offering. I was working there as a data scientist and kind of bringing new product. Then I moved to banking. I was data scientist there too. Then after that, quickly moved to consulting, management consulting, and I was the second person in a BCG office in Toronto that I was working on data for a while. And quickly right after that, after pandemic happened, I kind of was very had this entrepreneurship itch and was really thinking, when you come to the disruptions in the market, that's where that's as it's a level playing field get level for startups and big incumbents in the market. So that was the best. If you don't start a startup when disruption happened, when you want to start it. So I left my comfortable, well-paying job in management consulting, and I started work from homie. And and that was come from the pain point that I felt working in different corporate environment or startups.
Yeah, I mean, listen, over the last 25 years, if you started a company or if you have experience in data science, you are you're in this great area, right? It's so much like I've been there before. It's one thing starting a company in a field that's old. Like my first company I started was in digital printing, right? It's like the worst field. Printing field, this is like, it's not popular now, but at the time, this is, almost 30 years ago, uh, you know, people were using offset presses to print brochures, right? And I got involved in digital printing, when I was in that business, I quickly realized this was an industry I did not want to be in, right? And then I go into some other industries, uh, you know, where you had the old adage, you have a rising tide floats all boats, right? It's so much easier to build a company in an industry that's just taking off than an industry that's either going down or just matured.
Yeah,
Uh,
that's what they say. Like you want to build a company in an area that's big and it's growing because the new opportunity get created. So if it's big area and not growing, it's already saturated. So you
yeah,
want,
yeah. I mean, I have this friend who he started this company 30 years ago in in data science, right? 30 years ago, right? And he's literally the worst business person I think the second worst business person I've ever met, because he didn't make anything of the company, right?
no way.
Yeah, he hit this industry in its infancy, right? And it didn't make any. He made money, but it was a joke, right? But and he kept the company for 30 years, and he's still just unbelievable. But um, now you got involved with. How did you come up for the idea for? Well, first let's take a step back. What does I'm trying to find the name of your company? WFHomie.
Yeah, work
WF
from home. Yeah.
Yeah, a work from homey. That's what it is. Okay,
Yeah.
WFHomie. What exactly does it do?
So when the pandemic hit, I think that I just combined your both of question in one. I think that would be create a good understanding of why I started and what it was doing. I was working at BCG, like doing a lot of project. I was working with people in Germany and with people in LA, and I was in the East Coast. So you could imagine how my day would look like. Yeah, from early morning to late night, just making sure we are having the proper sync communication. And before that, everyone traveled in one location, and we did the project in one location. People from Germany, people from LA come to one location. We did it like a work a few days together. What I noticed right away, just if you have a team that, for example, you're doing running call center, yeah, there is no reason the call center people working a call center would be together. Just they can take the job while they're around the world, like they can work from their home. No drop in the productivity. But if you are working in a high performing team, a high performing environment, which need a lot of creativity, that's kind of the remote going remote, not being in this same location, hit a lot of companies. And I felt that with like myself when I was working there. Yeah, either I should have been always on the calls or I was out of sync. Then I noticed like, hey, there is a better way. Like there are companies who are async. They're like working in different time zone. One of them is GitLab, and they are successful. Yeah, so we're trying to bring that mindset of, hey, you can have still a high performing team while working in different environment, not being everyone in the same place. And so we like that was kind of the triggered idea. Let's go there and fix the problem. I'm a data scientist, so my first gut hunch was like, hey, we can use the data to solve this problem. Yeah, we can look at how people are doing, where they are falling short, and we create a recommendation systems like, hey, fix this problem and your team engagement become higher while it's still remote. So it kind of was a mix of using AI plus a playbook or the knowledge in the industry to help the team, remote teams, like high performing remote teams, get back to their original place. Yeah.
So let's try to keep it simple terms, and that is what what were you looking at? What type of data were you looking at to determine, I guess, if someone's productive?
So there are two things here. I just want to like separate it right away. There is productivity and engagement. Yeah. Uh, Measuring productivity, that was coming later in our product. Our goal was mostly engagement, and we believe that if your team is engaged, it automatically improve your productivity. Yeah. So that was kind of, yeah, let's build a product, take a leap of faith, and do the like measure engagement and then go to productivity. So our focus mostly and our data that getting was mostly around engagement. What type of data we are doing? We were doing there were a few goals for us. Yeah. First of all, we wanted like a real time data. We wanted unbiased data, and we wanted different source of data. So three things: real time, unbiased, and we make sure like we have you know a comprehensive view of what's happening. Uh, so we had a mix of questionnaire that we ask monthly from employees, and also we look at like their how they are reacting. So for example, a Slack and team, not just looking what are the message of people getting like freaked out, just looking how often people are messaging to each other, or if they someone put something, how even like what emojis people react to. Is it like is there interaction inside your team? How's your async communication look like? Documentation, and we could look at all of these one and like slice and dice the data based on the regions, time zone, cohorts, and like a lot of things like, hey, like the young people, like younger people are doing good, but like your senior levels are not doing that great, or vice versa, or the people you have in Berlin are not doing good, but the people you have in Philippines are doing well. Yeah. So we wanted to like have a complete view of what's happening and then start giving recommendation how to fix that.
And so, like, to keep it simple, and uh, I don't know a lot about this, but would you put software on someone's desktop, and then that software collected data to see what applications they opened up, how much they were involved with the interaction of those applications, how much downtime they had? Is that what you were doing?
No, no, actually, as I said, like there are
It was just
two.
a questionnaire.
It was a questionnaire, and we look at your because okay, let's step back. Yeah, you were in office, and you wanted to see if like you have a developer and that developer is happy or not. Yeah, with his work, you could look at the guy in the office like, oh, this guy is like working like 7 a.m. to 7 p.m., not happy all day in meetings. Like, okay, this sucks. I need to go change it. Now you're remote. Your team member could like not be happy, could be 7 a.m. to 7 p.m. fully burnout, and you would never notice. So it's like how we can find this out. Questionnaire is obvious one. We did questionnaire, but we did it in a fully different way. I'll get to that one. But the second piece was like I can have now you're remote. Every interaction that you have with your team is kind of recorded. Yeah. If I'm on a Teams, on a Slack or a group chat, I can see how a person like if he's engaged in the conversation. I can look at his calendar and see like how busy he is. Yeah, it's like oh, is my like engineer shouldn't be in a meetings like more than like 20 hours a week. Yeah, in meetings with more than like group meetings. If that is happening, that sucks. So we didn't need to even install a software. We could have looked at like the communication that happens inside the company. So now every meeting is in the calendar. We have a track record of that. Every communication is on a Slack. We have track record of that. So we use their APIs to get this data, and we start correlating that one with the engagement. It's like, hey, if your engineer like not engaging in your conversations, he's on meeting all day, and he's online from 7 a.m. to 7 p.m., he's going to be burned out. He's going to leave the company. He's not going to be productive. Yeah. And we also tap that one with the marriage that data. We just simply asking not just questions about like a pulse check, like how do you feeling today? Yeah. So we didn't rely on one point of data. We gathered as much as data as possible to get a cohesive, comprehensive view. And with reasoning, go back to the HR teams like, hey, you need to change this behavior. You need to put like a better practices, like no Wednesday meetings. Yeah. or you put meetings like, hey, I want everyone to shut off their like get out of their laptop after like 6 p.m. Just giving instruction to your team to push it towards better practices while being remote, and preventing people from burning out.
How is though that how you were asking questions? Okay, let's just move on to the scale stuff because that's probably more important. But um, so you started the company in 2021, and right from the very beginning, you had the idea of the mission was employee in satisfaction and engagement. Is that was the mission from the very beginning?
Yeah, the mission was like employee engagement and satisfaction, just making sure like people are uh, like people don't leave your company because like silently, what they call the terms like the silent quitting and all of those terms came up. But yeah, mostly engagement, just making sure you know what's happening in your company culture. Yeah, that was the
Okay.
goal.
So you were looking at what would have happened if everybody was together in an office and saying, okay, how can we identify these issues from both a productivity standpoint, from a satisfaction standpoint, now that everybody's working remotely?
Exactly,
Right.
exactly.
All right. So you started the business in 2021. Did it require any angel funding, anything like that?
Yeah, I mean, we I started the company. We went through a accelerator right away called at that time was Accelerprise. Now is Forum Venture. Is an accelerator like in North America. They have presence in Bay Area, New York, and Toronto. And there we start doing our customer discovery. What's the problems? And I start getting like our initial customers. Yeah, like create a momentum.
But you
And
got angel. But you got angel. Feel you first got the angel funding, or you started working on the product first, and then you got angel funding as you went along.
so in 2020, we did like a very like a Wizard of Oz solution. I don't know if that people know about it. Just kind of like put a very wanky version of the solution, very like uh, kind of one-time working solution to just see how does it work. We sold to one customer, and we started doing a lot of customer interview, and that gave us a confidence there's a problem here. Yeah, so we talk to customer
It's a
and
good way to do
people
it.
are people are willing to put the check down. Yeah,
Yeah. Yeah,
and
that's a number one way I think to prove to your angel funders that this is going to work is I have billable, I have clients that are willing to pay for it, right?
yeah, exactly. Like even like I mean, the product wasn't even put together, but the problem was so deep that people are willing to just put a check right away. Yeah, it's like, hey, I have a problem right now.
That's
How
good.
to solve it? Yeah,
Yeah.
and then we went through like we just pitched that one to forum. We got into the cohort like January 2021. So we started a program with them right away. They gave us rate us like 150K check, like a small check to just and the goal of that was like, hey, let's get this money, like let's instead of that Wizard of Oz solution, create an MVP, bring like 4 logos, get some subscription. Like that was our goal. Is okay, we want to make sure we have ARR subscription. People are paying us to do this continuously, and we did that successfully. Just going through my network, going through our wait list that we had. Then we started doing fundraising in the summer of 2021, our seed round, and that was like were able to close that in like a couple months, like $1.6 million. Yeah, uh, because we had the customer, we had the traction, we had the upseller right there, so we were like able to raise the money like
Well, what?
pretty
Why?
straightforward.
I mean, 1.5 million. Why did you need the money? I mean, how many? I'm assuming it all went to salaries, right?
Yeah, I mean, like that's a good question. Why you need the money? Uh, for me, that was a solution that wasn't like I just stumbled upon right away. Yeah, it was a solution that a lot of people were going after it, and being into the market first was a important Sorry, I think my camera is got
Just let it
very
go.
blurry.
Don't worry about it. Yeah.
Okay,
Yeah.
sorry.
It's
I'll,
just,
I'll just,
you. Sorry for YouTube users who are watching this on YouTube, but go ahead.
yeah. So we kind of I lost my train of thought. Yeah, why raising money? The only like you need to have a reason to raise money, and our reason to raise money was there
You
is a
want to get
race
it, you
right
wanted to
now.
get out there first. You wanted to be the first
Yeah,
one out there. It was now okay. So I want to jump ahead, and then we're going to come back. You sold the company 2 years later, after in
yeah.
2023
We sold the company end of 2022, actually, like the
at
December of
2022. Okay,
2022. Like yeah.
gotcha. Okay, December of 2023. So very very short, and I'm going to get right to the heart and soul of this, and that is why. And then we'll backtrack again. I mean, well, I'm going to ask the question: what did you sell it for?
Unfortunately we cannot disclose how much we sold it for at this moment. Yeah, we signed through it. I can tell
All
like
right.
we yeah. Go ahead.
What was the? Let me. I can ask. Let me ask this question: what was the multiple that you sold it at?
So
So for
I
our
can tell
listener,
I can tell
yeah.
this one.
So for our listeners to know is when someone goes to buy your company, they typically will buy you uh, X times your EBITDA, earnings before income taxes, right? And and so and we're going to get into a little bit more about that in a second. But can you share with us what your multiple was?
Yeah. So our multiple was around like I can give a range between 8 to 12. So it was a
Okay.
good range. And the reason
Right.
behind it, I just want to clarify, like uh because we were I get to that one. Like we had around 50,000 users. We weren't monetizing. I don't think.
Wow.
I think.
That's a lot of users in 2 years. Oh.
Yeah, yeah. So the issue
But it
is
wasn't
with
50, but it
multiple
wasn't 50, but it wasn't 50,000 companies. It was 50,000,
50,000
right?
employees. Yeah, yeah. 50,000
Employees.
employees. Yeah,
And how many companies in general were your clients? Because you're selling it to their clients, correct? I mean, to
yeah, yeah.
companies, right?
Yeah, we sell it to companies, teams, and even like you have a small team, you can start using the product. We had around like I would say like 60 to 70 logos in our so company logos, yeah, like companies in our portfolio,
Like
like as a
60
partner,
companies.
yeah,
Okay. Okay.
yeah,
And okay, thank you for sharing. So for our listeners to know, the more valuable your company, the higher the multiple will be. All right.
exactly.
Yeah. So 8 to 12 is valuable, and you would expect that in the technology space, honestly. Okay. Um, you know, if like some of the businesses I had, the multiple was 4 to 6, which means that it's a very mature industry. And the multiple really means is that if you kept if you kept the company and you did the same amount of sales every year that you're doing now with no growth, it would take you 8 to 12 years to make the money back that that someone bought your company for. Okay,
Eh,
so yeah, so
yeah, yeah.
you made so here's the $1 million question, right? When did you recognize that there was a scaling issue with the business?
That's exactly is like the point that we noticed. uh I'll go like a little back and tell you the story. It's like when we started, we had like amazing growth, 20 month over month growth. We were like closing logos right and left, like uh we had companies, like we had the biggest media company in US, like just using us on a pilot. We had the biggest supply chain company in US was using us on a pilot. We have a few big fintech using us on a regular basis, but we couldn't monetize it very well. Yeah, while we had 50,000 users, we had like very strong logos. Uh, we noticed this is not why we are not monetizing it. And when we started, it was, I don't know if you guys remember, like a year ago, 2 years ago, there was shortage of like a white collar people. Yeah, it's like professional, tech professional, finance professional. Like it was shortage. Everyone was worried about burnout. Everyone was worried about the retention of people. Yeah. Then in March of 2022, kind of the market started changing rapidly. Yeah. It went after, it's like, hey, I want to hire this engineer. Like I'm gonna be willing to pay like a 200K signing bonus. Just bring another engineer to my team. So like by the way, I'm gonna lay off half of my team. I'm gonna lay off like 20% of my team. So our solution was really focused on retention, kind of become like drop from the top of the list. Yeah. And uh, then I started thinking about it, like why this is happening. And who in, and we notice like people who are in HR space, if they're doing payroll, if they're doing HR system, like very, very crucial stuff, they are not feeling that hit. We are feeling the hit because we were solving a problem for a period of time that was really important, and maybe in today's economy is not that important. So the growth that we had was like, oh, we are doing amazing stuff, become an uphill battle. It's like going through. And now I'll just say CAC to LTV ratio, which is the cost of acquiring customer compared to how much we are making money, uh, was not favorable anymore. So our cost of acquisition went high. Our lifetime value of the customer, or ACV, annual contract value, stayed the same. That was the moment that, hey, either we need to like pour a lot more cash, like go raise another, like instead of 2 million, raise $10 million, and pass this valley of death of like, or we need to fully pivot and move to payroll and HRIS systems to complement our solutions. And the company that actually bought us was having that, and that was a perfect. The reason we could sell in that multiples because they exactly had the system, and they can go and sell to all their customers our product right away,
So
and they could go
they had very little cost of acquisition of a client. It was all upside for them.
exactly all upside. You could like, and our solution didn't need much of integration. It was like just roll it out. First of all, like I don't know how much you use your HR systems or payroll, but probably the employee doesn't touch that much in a day-to-day basis. But with the solution that we had, we create a lot of active users with the customer for them too. So the multiple is the simplest thing to talk about it, but no one talks about how the multiples is not a complete view of what's happening. Yeah. I would like describe it in three ways. How the like beside what else beside exists beside multiple. Like one of these is revenue, obviously. Yeah, you're what you mentioned, EBITDA. But the other thing is like how much potential exists that I can make money out of this, like buying it. Yeah, so EBITDA is kind of like, if you think about selling company like selling EBITDA, if you are saying like, hey, I'm selling this pen with the cost of production, yeah, how much does it cost me to make it? But that market doesn't work like that. Market is based on a supply and demand, how much value that pen can add to me, to my day-to-day business, and that's how much I'm willing to pay. That's why I'm like, revenue is only one way to look at it, but there is like, we were kind of a strategic buyout because we could add so much revenue to the company that buy us right away if they were right partner.
Yeah, well, listen, I'm sure that the company that acquired you said, "Oh, we'll make our money back in 3 or 4 years, and so we're willing to pay 8 to 12 because we can just get our money back. It really gets us in a stronger position with our clients. This is going to be a big money maker." I mean, nobody buys a company if they think that the sales are not, if they have no effect on the growth of the sales. So this company, and plus they kind of eliminated the costs that you had of acquisition costs. So that was a big deal. So did they uh, did you recognize too that, I know I've been there because I've had businesses, all my businesses, you know, my business partner and I, he had a very successful company that he sold, right? For a high multiple, by the way. And I haven't really sold. I have one company right now that's going to be sellable. And other than that, I really haven't sold my companies, right? They were just been good money makers, quality of life businesses, good money makers. Uh, uh, so him and I both say, if we were to do this all over again, we would have gone for something bigger, a bigger idea, something, and let's use that word, scalable, right? Much more scalable, right? Now my business partner, Keith, his company was, well, again, it wasn't exactly scalable. So, so when, let me ask you, so this is what and I've done this before. I've kind of run companies into the ground that I've had to move on to something else, right? Because I recognized that the business wasn't scalable, right? I couldn't sell it, but it was still a good money maker. But I couldn't find a way to pivot those companies, so that they became bigger and scalable. Did you recognize that this just is not going to be a scalable model if I went out on my own and just raised funds?
Yeah, exactly. That was the situation. So when our CAC to LTV went up, it was like, hey, I have a few solutions in front of me. Yeah, go raise a hell lot of money and like keep going through this one, or like figure out what we are doing here. And I'm not saying like, oh, it just was all my decision. That was not a good time to raise money. Also, like if it was, we hit that like a year before, uh, maybe I would have done that. Which in the hindsight, I would say that was a mistake, because essentially this company wasn't like, the idea wasn't, there was not much like what they call the word TAM, total addressable market. It wasn't that big, yeah. The total addressable market, and it was what they call it, like it was a vitamin or a painkiller. It was also a vitamin, so it could have go raise money, but at the end of the time, you really need to be worried about your opportunity cost. Yeah, it's like, hey, I can go make a
Yeah.
good money here. I can go make like a good salary here. Yeah, but can I do something better with my time? And that was the question like I had for the from the, I would say, like the summer of 2022, but to until we sold the company. It's like, can I do something better with my
Yeah,
time?
I think like I look at my businesses, not two of them I have right now, because they're different plays, that the two businesses I have right now, financing solutions and elite federal funding. My business partner and I wanted good businesses that didn't have a lot of employees. We wanted employees, in essence. We had been down that path, and then we wanted something that would last a long time. So, so, but my point being is, with my other businesses, you're a young guy, you learned about scaling and market disruption at a young age. The term market disruption for me wasn't involved, and it wasn't around 30 years ago. Like, that market disruption as a key ingredient to what venture capitalists are going to buy. Okay, forget about angel funding for a second. You know that I don't remember that term coming about until 15 or 20 years ago, right? And I was late to the game. I think I do remember the word scale in my third business. I thought, I had an objective with my third business, which is I'm going to scale this to 10 million, and then I'm going to sell it to somebody, and I'm going to do something else. I thought I could do that. I was going to make a regional play in the United States, build a company in this region in a mature market, and then sell it to one of my competitors. And that's what, by the way, like the purpose of the MBA podcast is to get your company to 10 million, because when you're talking about a company that's not venture backed, or sorry, angel funding backed, $10 million in cash flow per year is the magic number for when somebody is starting to be interested in buying you. So,
Yeah.
Go ahead.
I just want to say, like, that's a good number because, like, if you want to hit 1 million, like, you can have a bad idea, like, terrible idea. And I would say, like, there is playbooks how to take it to a $1 million a year. Yeah.
Definitely. Yep.
But
You just
that
hustle.
if you can,
You
yeah.
hustle, Yeah.
But then you reach that place, like, hey, I want to take it to $10 million. Then you hit the problem. It's like, if this is a bad idea, it's not going to go to $10 million.
Yeah. And the
How
other thing
good
is
you are.
that the other thing is the owner can't be the only person really doing the rainmaking at 10 million. You can't be the rainmaker at $10 million in revenue. You have to had to have taught other people. You have to have business processes. You have to have now listen, we're just talking revenue. We're not talking about profit. Okay. So there's another
Yeah.
component to it as well, right? You could be $10 million in sales, not making any profit. And what the hell are you doing? I hope you're going for some scale there. And I tell you, that's a little crazy without angel funding and venture capitalists again. Again, like nowadays, very few people build companies without angel funding and venture capital. Like it's the thing that my business partner and I both tell young people, not every idea has to have angel funding and venture capital. And that's like a foreign concept. All my businesses, I never had any angel funding, never had any venture capital. And I would say, in fairness to everybody that's out there, I think if I was to do it all again, I would go to angel funding, as my only strategy, and it probably would have forced me into better ideas because it had to be much more scalable than the quality of life businesses that I built. So.
That's such an interesting thing. Like, I went through angel funding, and now I'm in the opposite camp. I was like, hey, I'm not gonna, because angel funding put you in a position that's like, now like, it makes quitting hard. If, like, your idea is not good, then you have like a fiduciary duty to your investors and everything. So you need to keep the
Well,
boat floating.
what is your, I see it all the time with business owners who've gone the angel funding route. And it's like, are they building a company to make money or are they building a company to raise money from angel investors? Because they tout how much money they've raised. I'm like, I don't care how much money you've raised. Tell me how much you're making. Oh, well, that's not there yet. Okay. Well, I'm
Yeah.
sorry, but your proof of concept, that's why when you did that early on in your career where you got a paying client, I mean, that's pretty important because you have to listen. I have to do it off the top of my head. Maybe there's a number of things that are really important in businesses. Number one is, do you have it's not number one, but a working product or a working service? Okay. Number two, what does it cost for you to acquire clients? Number three, what do you make off of each client? Okay. Those are three really. And number four is, how can you build processes or scale it so that your unit cost, your serviceability the cost per unit or service goes down as your sales go up. Okay. Because those are four fundamental parts of a key. And then there's actually a fifth one. Oh, there's lots. The fifth one is, how are you going to finance it? Okay. Because really, angel funding, venture capital, bank financing, factoring are all there to finance growth of a company, because the money you pay in financing it should be less than what you make by selling more of a product.
Yeah. Yeah. That is like really true. And honestly, you, like, as a founder, you need to figure this stuff out. Yeah. You cannot outsource it. Yeah. So you mentioned about the product. You need to, like, when you start a company, you need to have, first of all, a vision like, where you are going and what problem you are solving. So I think, like, that's the most important one. And then, I mean, scalability is something we talk a lot. I mean, there is nothing wrong with having a business that is not scalable. Yeah, you can have a business, make money, live a life, and it's great. Yeah, a lot of companies go make business, like they have businesses, they go make I don't know, like 2 million, 3 million, a million, whatever. Like you can have a restaurant and make that,
Sure.
and the restaurant is not,
Yeah.
there is nothing wrong with that.
Don't go into restaurant business. But okay. Yeah.
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 But you need to have, you need to be honest with yourself. Like, hey, I'm building this one to, like, sustain myself. Yeah. If you're not doing that, like you have a bigger dream, bigger vision, then you need to be worried about this stuff, scalability, like how I can scale it. Yeah. There are enough people out there to reach out, and they are willing to buy X amount of it from me. And the best way to calculate it, a lot of people come and say, like, hey, I don't know, the gardening business is like $10 million, like $10 billion business. If I get 1% of it, that become 100 million. That's just totally wrong. That's like fundamentally wrong. The best way to calculate to see if the market is big or not is put up a price point for your product. It's like, hey, I'm selling like Calendly, for example, like a calendar booking. I'm selling this one $10 per month. And how many people I would imagine buy this one? It's like, oh, it's a professionals, companies, X, Y, and Z. Come up with a number. It's like, hey, there could be like 10 million people buy this product. So like 10 million people buy this product times $10 I'm charging them per month. That become $100 million. Now that's the way to calculate your market. It's like, hey, go and ask this question. It's like, hey, I'm selling this one specifically to chiropractor. It's like, how much you are selling is like, hey, I'm selling it $10 per month. Like, how many chiropractor exists? Like 1 million. And then you can say, okay, so that's become like the best case scenario, become a $10 million company. Yeah. Like the not going like, hey, chiropracticing is a $10 billion business or something like that and get 1% of it. This is not going to happen. So this is the best way to just see the first part. It's like, how big is the market? The second piece that you mentioned is like, how can I get it? So you are selling this product at a $10 per month basis. So you make $120 per year. How much you should spend to make one customer? If I spend, and this is pretty easy, yeah, I can go and start a Google ad or a Facebook ad, spend $100. Like, hey, can I get one customer or not? Like, just go and test it out. I spend $100, $200, $300 on a Google ad, Facebook ad, and try to see if you can get how many customers, and that become your CAC. So your CAC to LTV ratio, like assume how much money you can make money on that, it should be less than one. Like the number should be less than, what is it? Like the ratio should be around 3 or less. Yeah.
Yeah.
And it's like, now is a playbook. Just like you have it, you have everything. I know how much does it cost me to get a customer, how much I can make out of it, how much I should spend on acquiring them, and then like that's it. Like then if this is a scalable idea or not. Again, nothing wrong to build a product that you charge $10 for chiropractor. This is not going to be a scalable more than $10 million. You know it. Everyone knows it. The VCs know it. The angel funds knows it. So just go through that practice.
Yeah, I think at the end of the day, and listen, I always had this idea. I want to write a book about where do business ideas come from, and break it down. And I had a mentor who would kind of always help me kind of think through how to find my next business. And I think it comes down to one thing, and that is you want to find these major pain points that people are having that they're willing to spend a lot of money on. And that's really the simplistic way. And you want to really make sure there's not a lot of competition in that space. And by the way, if there's no competition, you got to understand why. Okay. And if there's just a couple, you have to understand what they're doing. Okay. And if there's a ton, my guess is that's not a good industry to be in. Okay. So I think it comes down to find a problem that people are willing to spend a lot of money on. And that's the nature of building a really, really good business. Now, we all talked about how we're going to wrap this up, but how angel funding isn't really always the best way to go. My attitude is the idea determines if it's going to be angel funded, if it's going to be privately funded through cash flow, if it's going to go public, if it's going to get venture capital. It's the idea will dictate your strategy going forward for how you're going to finance it. So, Reza, I'll let you wrap it up with one last thought.
Yeah, I mean, I would say I just got come out of a conversation with a few people, like a friend of mine who was working for Google. Uh, I just want to put it out there to the people who are working jobs. Like, always think about like the opportunity cost. Yeah, think about if I'm not doing this and doing something else, would I add more value? Whatever your value system is, like you want to help the world to be a better place, you want to make more money. And there is no one answer, but think about it as like, hey, I'm doing what I'm not doing, how much I'm losing there,
Yeah,
not how much you're gaining from what you're gaining.
yeah,
So
and
that
have
would be,
I agree, and have a strategy because like the idea is so. Let's give the most simple scenario. You are a data scientist and you're working for another company and you're making $200,000 a year, right? Plus your benefits. So it's at least 30% of your salary plus is benefits and all the other stuff, maybe stock options. You got to take everything into an account. Okay. You need to say is, okay, if I work for this company or any other company, I might make it up to $300,000 or $350,000 in 10 years. You know, what would I do if I did it on my own? Okay. And
exactly.
by the way, I just want to tell you, out of all the entrepreneurs I know, I don't know one that started a company because they wanted to make more money. That's just, I don't know anybody like that. And I know hundreds of business owners. It was an important part of it, but it wasn't the primary. The number one reason that there's two. Okay. The number one reason that I hear all the time is I just had to do it. Okay. And number two is I wanted to control over what I worked on. I wanted control. It was all about control. I didn't want somebody telling me what to do. I wanted to make my own decisions. If you can't answer those two questions, because you're not going to make more money for a while. You're not.
You're
Okay.
not.
And so it better not be your primary motive because, and I tell this to my son, who's actually a software engineer in a data science division of a major bank, a young kid, 22 years old. And I show him, I say, listen, if you invest, he invests 30% of his salary into the stock market. And he has a strategy that he's going to retire when he's 50 years old. Okay. And I show him, I say, listen, if you start your own company, you might have all this upside. But if you stay at your company or stay in the industry and you put money away, you'll probably make the same amount of money that you would if you opened up your own company. So that should not be the driving force if you're going to open up your own company or not. And I think he's going to go with that strategy, which is just continue to work for another company and just save his money. So, yeah.
Yeah, I mean, like you put it great. They say like, hey, how happy you are is like at a job is really depends on the ratio of control to responsibility. Yeah.
Yeah. Yeah.
uh, I worked in a place that's like I had so much responsibility and not that much of a control, and now I just want to say like, yeah, the income could be the same, but definitely you're gonna be happier if you are.
Well, listen, I'm 58 years old. I look back at my life and I'm like so happy with the way my life has transpired professionally. Okay. And also personally, as far as the quality time I've had with my family, listen, one of the big, I worked for Xerox for 8 years. And when I first started my career, I didn't want to travel a lot. I thought
Yeah,
that was a mistake for me to be close with my family. So, anyway, Listen, I got to wrap this up. I know we spent a little more time today because I thought it was an interesting topic. I'd like to thank so very much Reza Farahani for coming on today's podcast. And if you like today's podcast, please feel free to share it with a friend and also subscribe on your favorite podcasting app. And please also give us a review if it's 5 stars, if you're looking at, if you're really happy with our podcast. And if you're looking for a line of credit for your business, please feel free to visit our website at fscreditline.com. Razi, if anyone wants to get in touch with you, how would they go about doing that?
Awesome. And thank you, Stephen, for having me on the call. Enjoy the conversation very much.
Yeah, and if people want to get a hold of you, how could they do that?
Yeah, I mean, like I'm in LinkedIn, Twitter, all Reza Farahani. So you can find it like me on LinkedIn and Twitter with this with that tag. Yeah.
Yep. And so it's spelled Reza, and his last name is Farahani. And so, my takeaway from today to wrap it up is, you need to look at your business to see how scalable it really is. Sometimes you could talk to other people about it. And if you don't think it's scalable and you really don't, if it's not really for you, you either have to do one of two things. You have to find a way to pivot that business to make it scalable, or you need to maybe start another business, which is what I did, right? I said, oh, well, this is really scalable and I'll run it into the ground, but I'm also going to be starting some other businesses at the same time. So to see if I could get another scalable business. So other than that, I just want to wish everybody a great day and good luck. And I hope you learned something today. I'll see you later.